Now, many times in India, what happens is that when you're going to insure yourself or your family for 5 lakhs or 10 lakhs or 20 lakhs or whatever value it is, then it automatically goes up. This principle pertains to the level of interest of an individual expected to have in a particular policy. Insurers collect premiums from a large number of policy holders to create a pool of funds. Good morning and welcome to the first session, Unit 4, third semester, Insurance Management and BCom. We're going to talk about insurance business, and especially this is going to be on the life insurance business. Now, life insurance means to say that there is a contract between the insurer and the policy owner. So the insurer is agreed to pay an amount to the person insured or his nominee either on the date of maturity or on the periodic interval, or in a very unfortunate, even when we are talking about the death of the policy owner. So the policy owner has to pay a fixed amount called as premium in periodic intervals, which means he will be paying it in terms of annual, or he might be paying it in terms of monthly, quarterly, or it might be half-yearly also. So you are going to pay it in terms of a periodic interval. Now, this policy owner is also allowed to choose the type of payment cycle. Now, many times in India, what happens is that when you're going to insure yourself or your family for 5 lakhs or 10 lakhs or 20 lakhs or whatever value it is, then it automatically goes up. The value starts moving up, the premium starts moving up, so you might not be able to pay it in one time, so you can take your own time cycle. When we talk about the principles of life insurance, we need to talk about insurable interest, which means to say that this principle pertains to the level of interest of an individual expected to have in a particular policy. The interest could be a family bond, a personal relationship, and so on. So based on the interest level, the insurance company may accept or reject the application to protect the misuse of the family or the policy altogether. Now, what is this all about? So whenever we take an insurance, you need to understand for whom and what is the purpose under which the life insurance is being taken upon. So based on that contract, the insurable interest must exist at the time of the policy is purchased. Now, when let's say that it exists for the own life, spouse, children, business partners, key employees, credit are in the line of the debtor. So whenever you're taking an insurance policy, one has to specify for whom are we taking this policy. It's for the family, it's for the kids, or it's the corporate insurance that you're taking in. Who are the people who are involved in that insurance act? Characteristics, the first thing is risk pooling. This is the underlying concept that allows insurance to function. Insurers collect premiums from a large number of policy holders to create a pool of funds from where the fund is used to pay the claims of the few policy holders who raise the claim on different occasions. Why do we do this? Because this will spread the risk altogether. When you have to go back to the proverb in English when we say, do not put all the eggs in one basket. That's exactly where insurance team also comes into picture. They want to keep the risk as far as minimal to possible levels. So what they do here is that they spread the risk, which means you collect money from diversified sources, put it into different options, put it into different asset classes altogether, spread the risk, make it minimal as far as possible so that the financial burden of the entire group comes down. So let us not get into the picture of taking too much financial risk in terms of running an insurance business. The aim of insurance is to handle the claims when they are being raised, but at the same time, the insurance company should also make an effort to keep in mind that they do not burn their fingers by taking a huge amount of financial risk. So that's where the characteristics of insurance falls in place. Followed by the utmost good faith, which means to say that purchasing an insurance is entering into a contract between the company and individual. This is done in good faith by providing relevant details with honesty, Covering any information from the insurance company may result in serious consequences. And that's why the insurer must explain the aspects of all the policies. And if there are any unexplained factor, they must be completely disclosed. They might be told with all the terms and conditions. Now let's have a close look into this slide altogether. Insurance is always an understanding between two people. That is the insurer and the person who's going to get insured. That is the individual. In case of hiding any facts, trying to deceive the company, trying to tell a lie that I don't have a pre-existing disease, for example, and I go ahead and cheat the company, now that's not only a financial loss, but an ethical or a moral loss to the company. So it becomes very important for the insurance company to understand the individual whom they are going to cover. Let's understand this very, very threadbare. Why? Because if you have a pre-existing disease, you have a particular medical conditions, you are suffering from something, so we can tailor a package according to that. So if you start telling lies to the company and tomorrow you come back and claim on certain backgrounds, that the company would not be in a position to honor your claims. So that is why we say this clearly, that any habits, any kind of medical conditions, any kind of pre-existing diseases must be disclosed to the insurer at any given point of time, so that the insurance can also be made clear with all the necessary factors to keep the individual insured all times. What are the characteristics of insurance? Risk and minimal loss. Insurance is risky and companies do have business and make profits in the mind, keeping the risk factor. The principle of minimal risk states the insured individual expected to make necessary action which limits her or herself from any hazards. This includes a healthy lifestyle, getting into regular checkup, health checkup, and more. So what happens here is that one has to understand the factors very, very clearly. Why? Because whenever we are talking about the insurance factor, the risk and the minimal loss, which means to say that an individual is expected to take necessary action to prevent him from any hazards. At the same time, insurance companies are not running for charity. They have to keep in mind that the business of insurance is to deliver profits and not just get into any kind of charity business or any kind of protection business here. So for an individual, whatever he or she does, there needs to be a minimum checkup, a minimum routine that needs to be followed in order to protect yourself. Followed by which, not a contract of indemnity. Unlike a property of health insurance, life insurance does not adhere to the principle of indemnity. So no financial value can be placed on human life. Policy is not designed to compensate an exact financial loss. Instead, it pays out a fixed, predetermined value in case of death. Now, one thing is true, that human life is priceless. So you cannot attach a value to the human life. In case of any unfortunate event, in case of anything that happens uneven or not expected, then we can try to compensate the value by providing a predetermined or a fixed value as per the insurance contract. But we can never say that that is the value of the person who has died. So what we do in insurance is that we try to give some value out here. Now, what are the basic features of life insurance contracts? Now, the basic features is that the offer and acceptance, like other contracts of insurance, the life insurance contract is also an outcome of the offer made by the policy owner, acceptance by the insurer. Generally, the life insurance contract is made in writing. Yeah, very much important for us. And then agreed to the sum of money that has been given. The insurer agrees to pay a certain amount or certain sum of money during the death of the policy member, owner, or on the maturity of the policy, whichever is earlier. Now, that's very, very important for all of us to understand here, because that matters a lot whenever we are talking about this situation. Similarly, when we are also going to talk about a very critical and an important factor here as we go ahead is the premium factor. Now, the policy owner is liable to pay periodically the amount of payment in the form of premium till the death of the policy or the owner on the expiry period of the policy, whichever is earlier. So you continue to pay your premium until your death. And you are supposed to continue this policy, either the policy ends or the life of the person ends. Whichever is the earliest, we go with that. Now, not a contract of indemnity, as I have told you, cannot equate death of a person, the life of a person, to a particular value. Now, that would be a severe damage. That would be a serious misunderstanding of life insurance. So you're not going to equate anybody's life. You're not going to say that this is the end. So you're just going to say that this is only a compensation that's going to be given to your life. Insurable interest: person who has developed, assigned a life policy need not have insurable interest. It is actually already present at the time of taking the policy. It's lending a helping hand. That means insurance company provides helping hand to all those people who are supportless, financially in case of death of insured. It's also considered to be the best alternative for making savings, and it covers all other risks. So life insurance covers other risks which are connected with the human life, especially in addition to risk and that of death factor. So all these things are very important for all of us to understand how things work. Now, what is a ULIP? ULIP is unit-linked policies, which means to say that there is an opportunity for the customer to go with a market-linked insurance factor so that you can also make some profit as you are trying to secure your life. So when we talk about the structure of unit-linked plan, which means it's two parts. Part one, you're talking about the insurance coverage, and part two, you stay invested in the market with the funds. So when the market moves up, the value of the fund will also start moving up. So for the policy holders to choose in different funds, hybrid, or when we are talking about the mix based on the risk tolerance capacity, the professional fund managers oversee to that this is actually an investment, this is actually an opportunity for them to complete the task and take it forward. So this is definitely a very wonderful opportunity, a rare or a unique opportunity for all of us to get into it, to understand how we can move it further. So this investment risk covering policy is very helpful for people who are looking at long term to make some money and also keep their life secure. Now, this is the difference that we are talking about, the traditional versus that of unit link. So you have coverage and fixed. There you have investment opportunity, you have a guaranteed sum and bonuses. Here you have a potential for high growth altogether. Now the premiums are invested in low fixed income instruments like government and securities. Portion of the premium is invested in the market. So definitely, yes, you're getting something such as equity, debt, or hybrid funds that are coming in. Insurer bears the investment of risk. So the policies have to be low risk profiles altogether. Policyholders bear the investment risk, which is higher due to the market exposure that comes into picture. So all these things are pretty important for all of us to understand at this juncture in terms of the business activity. Now, the individual or the group policies, as we are talking about, the individual or the group policies offer primarily in which who purchases them, who is covered and associated with the cost and flexibility. So individual policies are bought directly by a person for themselves or their family, while the group policies are typically offered by the employer or in collective association of the members at any given point of time. So whenever we talk about individuals and that of the group policy, individual is where you go and personally take one of yours, and the group policies are one where you would start taking it based on the company or on the nature or type of the employment. Followed by which the group policies and individual, organization takes it, here individual, lower premiums, but here it will be higher premium. The best part, this is uniform for all, but this is customized. Usually a medical test is not required because the company is giving you the undertaking. Here it is required. Typically no waiting period, but here there is a waiting period here. Why? Because it's individual, so you need to take some time for that pre-existing diseases to get under control. Now, How does the unit link? Because it's a higher link premium factor, so the premium is split and we are able to take it to the next level. So you have the choice to mix, remix and take it forward. In a unit link plan, you can go ahead and select the type of funds under which you are investing. Now, the returns are not guaranteed. Why? Because it's based on market performance, and we all know that market is not always stable. So there is higher risk factor involved. There's a flexibility, liquidity that comes into picture, which is very, very important for all of us to know at this juncture. Why? Because most of the time this liquidity and this factor makes you understand how we are able to take it forward. So this is very important for all of us to understand how do we take the structure forward, how do we build the system forward. Now, the transparency factor. These policies are highly transparent as insurers provide regular updates on fund performance, disclose all the charges and other factors. ULIPs have a higher and more explicit charge when compared to the traditional plan. They include premium allocation charges, management charges, and mortality charges. These are all a part of the ULIP factors. And the types of thing which comes on the basis of duration and a whole life policy altogether. So whenever we say whole life policy, it will mature for payment only on death as insured altogether or attaining that 100 years of age. Now, we also know that ordinary or whole life policy under which the premiums are payable throughout the lifetime of the assured. The lifetime payment or the whole life policy, this is limited. This works under certain premiums and they are for a selected period of time. This will mature upon the death of the assured. So this is again based on certain time factor. Now, principles with limited thing, you can convertible to whole life policy. So it gives you the opportunity to convert the endowment policy after the expiry. But anticipated is one where you will see the combination of limited whole life and that of an anticipated endowment policy. Now, this is what we talk about. 18 till the last birthday factor should be there minimum. This is maximum of 60 years. And then the sum assured is 30,000. There is no limit. Now, for example, the term is not applicable. Here again, it's the same thing. The mode of payment can be made and there's a 5-year mandatory lock-in period to which the investments cannot be drawn. 80 years or 40 years from the date of commitment, whichever is the earlier as we know about. With this, I come to the end of this particular session. I hope and believe all the facts and figures that we have spoken through this session would be of a great help to you, both in terms of theory as well as in the practical walk of life. In the upcoming session, we'll be learning more about the insurance management. But until then, stay tuned, stay blessed, and have a great day. Thank you once again for joining me today on this wonderful session.